Good day to everybody who's joining us on this webinar. I know it's streaming out there. I know it's being broadcast nationally. So I know some people are in the afternoon, some people are in the morning, or if you're going to join us at a later date, thank you for tuning in. My name is Mike Boggiano. I'm the Managing Director for Lending One CRE. We are a middle market lender from $5 to $30 million. Providing financing both on a bridge and a permanent basis. I'm joined today with a very good friend of mine, Enrique Gomez of Commercial Mortgage Depot, a gentleman that I'm proud to say I've known for a better part of 20 years and done numerous business deals with him in the past. Enrique, you want to just give a little background about yourself before we hop into the discussion today about the current environment and where we are in terms of lending and what you're seeing in the marketplace?
Sure. Thank you, Mike. As he said, Mike and I, we've been friends for many years, back 20 years ago. So my name is Enrique Gomez. I'm the owner of Commercial Mortgage Depot. Commercial Mortgage Depot has been around since 2008. And what we do is we're correspondent lenders as well as mortgage brokers. A commercial underwriter. I do a lot of conventional commercial underwriting as well as SBA, certified NAGL, SBA. We do a lot of brokering for hard money loans, conventional loans, stated loans, anything that has to do with investors. We know how to do it. Basically, what we're doing is we're like a hub now. We've been playing as a hub for a lot of residential mortgage reps and a lot of commercial guys who can't put their deals together. They'll feed me the deals. We package them and send them to our different investors. If we choose not to do them, if we do them in-house, we'll do them in-house. If not, we'll broker them to other people. And that's how we've been doing our model for over 20 years. Before this, we had Commercial Funding Corp, which was the same model, just packaging, underwriting, reviewing, and sending out to the investors and try to work on the deals and close them.
Enrique, you span the market in terms of loan products. You do everything from SBA to bridge lending to commercial lending. I mean, given the recent volatility in the marketplace, how do you see your lenders, your bank partners, the lending partners respond to that volatility in the marketplace?
Right now, a lot of people are scared and nervous. Everybody's backed up with loans and processing. You still have a lot of lenders working out of their homes. A lot of the underwriters or processors, they're working out of their home. So everything's taking slower. As we all know, the rates have been going up steadily. Almost on a daily basis or weekly basis, the rates have been going up. Now hopefully they'll start leveling out for a little while. Everybody's just being more cautious with the rate increases. We're looking at a higher debt service. I guess the values of the properties are going to have to start coming down, or people are going to start injecting more money so they could debt cover a lot more favorably than what they were doing before.
Have you seen your lending partners start to drop leverage, or take a harder look at transactions now than previous, say from the beginning of the year?
I mean, apartment buildings are always going to be great. The retail stores, they're looking at startups and they're doing less loan to value. When they start doing the calculations, they'll increase the rate just to give themselves enough cushion, which is something we all have to start doing. We want every deal to fly, but we have to be realistic to make sure, okay, let's do a 10% vacancy for the stores. Offices, as we know, is taking a huge hit. But all the retail stuff, the restaurants are starting to come back. A lot of lenders are starting to lend on restaurants again, which they weren't before. So they're getting their feet wet and they feel more comfortable. But then with this whole virus thing pumping up again, they're just doing a wait and see. They're waiting and looking at every deal separately. They're looking at the experience of the borrower, which is the most important thing now, is they want the borrower's experience. And you get away with more stuff with experience than you do with the new people,
Hey, we talked earlier about, like, for example, the SBA used to be a fixed rate. Now they're requiring a floating rate. Is that true?
Yeah, right now, a lot of the lenders are doing quarterly adjustables. You'll have a few banks that are going to do a fixed rate for 3 to 5 years, but the majority and they're picking and choosing the deals that they want. The ones that are giving you the fixed rates, they're taking nothing but vanilla. And then when you got something with a little bit of hair on it, and you go to national lenders for the SBA, they're all going to be adjustables. I've been searching, even when they tell you it's going to be fixed, they start looking at it. A lot of them turn out to be adjustable rate mortgages on a quarterly basis. So it'll be prime plus 2.5 every 3 months.
I mean, I know we're a bridge lender as well, and I know that we offer a floating rate program, and we also do have a structured fixed rate, which is a hybrid between both a bridge and permanent financing, and that seems to have a whole lot of traction in the marketplace because people can actually get a committed rate up front as opposed to floating, so closing and then be on a floater thereafter. But yeah, it's definitely interesting times that we're in right now. Markets are definitely volatile right now, and we see it every day with the movements in the treasuries and the swaps. With that being said, though, lenders have adapted to the market. We tend to adapt pretty quickly. What have you seen from your clients in terms of how they've reacted? Have they adjusted to this rising rate environment? I know it's pretty shocking how quickly the rates were able to be increased. Have they adapted to where we are in the current environment?
I mean, they're dealing with it. A lot of the commercial investors, that's what they are. They're investors, not emotional. They're not looking at the rate as much as the deal and what it's going to do for them. I think when the rates started jumping up, everything kind of froze for a few weeks because nobody knew what was happening. So a lot of people kept shopping to try to get that lower rate. But then when they realize it's happening everywhere, the rates are going up, they learn to deal with it. I just had a guy now haggling over rates. I'm like, dude, they're going up. There's nothing I can do about it. As long as the deal makes sense, and that's why we always look at the numbers, as long as it debt covers, you got the profit and you're fine. So what's going to happen is either they're going to put more of a down payment or they're going to have to lower the prices. Right now, nobody's lowering the prices. The prices are what they are. The sellers aren't going to budge on anything. They still are not budging. So a lot of the investors are going to have to put more money down to make sure the property debt cover if they want to buy that property, at the rates that's happening now. So you're getting less of a mortgage than what you were getting a few months ago, and the rates were 4%. Now the rates are starting to go up to 5.5. So you're getting less of a loan amount for the properties that you wanted to buy before. They're barely debt covered.
I mean, I know that sellers have been towing the line in terms of, holding the line, I should say, in terms of their ask in the market for sales. But have you seen a trend in higher cap rates? Have you noticed are they holding steady in the markets that you deal with?
Cap rates are staying where they're at. I mean, it's a very aggressive market, so the cap rate's been going down like crazy. So, it's supply and demand. You still don't have that much inventory where we're at, and everybody's bidding on the same property. It's still, what shocks me, they're still bidding on the same property. So that's why the value hasn't gone down yet. There's not enough inventory. So I guess later on, once the inventory starts creeping back up, the prices will go down. But right now, the caps are still staying up there. I don't see them going high. They're still going low. They're still down on the cap rates.
And, I mean, you mentioned this previously. I mean, deals that were started 3 or 4 months ago, definitely, from a borrower's perspective and also from a lender's perspective, different assumptions were being made in terms of interest rates, cap rates, going in interest rates, and if it's a bridge transaction, there's assumptions for permanent financing. Are you seeing those deals that you have active in your pipeline with lenders? I mean, are they still moving forward with those transactions, or are they taking a pause? And I know they initially penciled out, but are they still penciling out today?
I mean, the construction lenders, some of the lenders stepped back from the market on the brand new construction. Some of them are still lending. They're at 65% loan to cost. They're looking at tighter because they want to make sure they're going to be able to get out with the cost of material going up like crazy. They want to make sure that once it's done, they're going to be able to get out of the deal and go into permanent financing. A lot of the banks that we're dealing with, do a lot of permanent financing. So they're trying to underwrite everything now. Then they want to make sure that the borrower has a lot of reserves in the bank in case there's something going to happen again with material costs going up like crazy. The bridge lenders just looking at everything twice and three times and make sure that there's enough room, enough juice. So they're not going to do a 75, 80% loan to value or after repair value. They're going to drop it more to 65% because we don't know what's going to happen in another 6 months. You know, rising material, rising rates. Even when you flip the one family homes or two family homes to an owner occupied, the guy who qualified for a 450 mortgage 2 months ago now only qualifies for 350 to 400, you know, because the rates are going up and now the payments are going up. So we have to take all that into consideration.
I know you do a bunch of construction loans, both on everywhere from single family all the way up to commercial. You touched on it briefly. Where do construction loans fall in this environment? Have you seen lenders dialing back on proceeds, or given that we are there is a labor shortage and the supply chain constraints? Are you seeing that timelines are actually being extended out because of that as well?
Well, yeah, they have to be extended because right now, even with the cities, for the inspections, it's not taking you as fast as it was before. An inspection might take you a month after work is done. You know, it's not like, okay, I got the work done today, let me go get the inspector. It's going to take a couple of weeks. We're working on a deal where we removed the tank. It took almost 2 weeks, so they got to come out and look at it to see the hole, to make sure everything was okay, and we could close it and go on with our lives. And what the lenders are doing also is they're looking for people with experience. If you don't have the experience, 99% of lenders don't even want to talk to you. They want to see someone with experience, someone who's done construction. We're doing a 34-unit building now, and they want to see experience. They want to receive reserves, and their injection. They want to make sure that the injection, everything's documented, and they're looking at 35% of the actual cost value of the project. You know, so you got to have deeper pockets now.
Okay, so if this is your first rodeo on construction, you're probably not going to get done in this market. You're not going to get financing in this market.
It's going to be hard unless you have a lot of reserves in the bank and you know you have enough money in the bank to do it yourself. Then yeah, we might do a 50, 60% loan to value. But when I have a lot of people starting and they want to build a one family, two family, they've never done this before, I just tell them, look, I can't help you. Or, you know, you should sell the project because right now it's hard. You know, you might have an estimate of construction for 200,000 a unit, but if gases go up and materials short, that $200,000 is going to go up to about 250, and it's going to mess everything up. You know,
as a lender, we don't particularly like dealing with first time developers because it's a learning experience and it could be a costly one, both for the borrower and also for the lender. That being said, what deals are getting done in this environment? I know you're very, very active. Again, the whole spectrum from single family, SBA into commercial transactions. Can you just give a few examples of what you see, the deals that you've been able to close successfully over the last 30 days or so, or deals that you have in the pipeline that are set for closing in the next 2 to 3 weeks? Even though we're in this volatile environment, you are still closing transactions.
I mean, multifamilies is always going to be number one. We're doing a few mixed use properties. You know, you have one store, 4 apartments, 6 apartments. So those are flying depending on the tenant. Like I said, the restaurants are coming back. So we're doing a lot of mixed use restaurants properties. We're doing single tenant restaurants. We're doing a lot of business type loans. But we're looking at the history and the year to date because we understand what happened last year. So we're looking at those tax returns, but we also want to see what the year to date is and see how your business is doing now. Retail strips, depending on the tenants that are there now, we could be aggressive depending on the loan to value and the length of the tenants. Everybody wants to see that the tenants' leases are going to have at least 5 years or more, or how long they've been there. We're doing a shopping mall now where they've been there for 10, 15 years. Those tenants, the anchor tenants are moving. You have a dollar store, you have a supermarket, a liquor store. These tenants are the anchor and they're not going to move. So, and then we'll look at the other tenants to see what's going to happen with them, see what the time frame is, how long the lease is left on them, and if they're going to stay or not. It just has to make sense. It has to be in an area where we see they need the stores, they need the type of business. The only thing really that's not doing so well is office buildings. You know, everybody's still virtual, and we still don't know how that's working out.
And on you mentioned restaurants. So are those primarily being done through the SBA or through local banks, or non-bank lenders? Where do you see
a
those
lot of them
guys?
through the SBA. We also have non-bank lenders that are doing with bank statements. We're looking at the tax returns, and we're looking at the deals, but you're looking at 65 to 70% loan to value on the properties, non-SBA. With the SBA, we could go up to 90%, but we're also doing non-SBA through either bank statements, tax returns, and just the loan to value is a lot less.
So those are the non-bank lenders.
Non-banks, yes.
You know, and those loans are typically what, $1 to $5 million? Or
No, we could go down to 500. So it'll be from 500,000 on up.
And you can say that you have the flexibility of doing that on a stated basis?
We do it stated, and we also do bank statements. So this, the more information you give, the better the rate is. So if you're going to give us a bank statement loan, the rate might be a little higher, or a stated loan with no doc is going to be higher, still higher. But the difference between that and the SBA, if you have the equity, the SBA, a lot of people want to do the quarterly adjustable, which right now is starting at about 5.5%, 5. So on a stated loan, the rate might be 7, but that's a 30-year fix. So it makes sense to go stated, or if you have enough equity in the building.
Right. Now, SBA, you doing both 504 and 7A transactions, or just, yes?
Right now, we're doing a lot more 7As and 504s, but we're doing both. It all depends on the loan amount and the type of loan that we're working on. Whether it's a hotel, we might do a 504 loan, a gravel company, owner-occupied warehouse, we might do a 504. But the 7A has more flexibility because you could include the equipment, you could include working capital. It's more of a project compared to the 504, which is more real estate related.
And again, those are typically just owner-occupied transactions, correct?
Yes, they have to occupy at least 51% of the commercial space in the building, or 51% of the space of the building.
And then transactions that are getting done non-owner occupied, the investors on the multifamily and retail, are those, again, primarily through banks or CMBS, or again,
doing a combination of, we're doing a combination of everything. We're working with some banks. We're doing the stated through our correspondent program. Some guys, we just did an auto repair shop, hard money. The guy just couldn't show enough income at all, had the money, so we gave him a bridge loan to get into the program, and he's fine. So it all depends on the program, the borrower, which box we're going to put him in. We look at the tax returns and analyze the whole file, whether it's worthy of going to the bank and if it makes sense, because the banks are being very conservative. They want to see reserves. A lot of the clients basically on their tax returns aren't that aggressive as far as income. So they're showing very little. And that's where we go into the stated box.
Is that a good percentage of your business where it's going to bank statements as stated? Borrowers are a little bit more, I guess, challenged in terms of getting traditional financing? Yeah,
what happens is you have a guy pulls up in a Lexus and he's making $20,000 a year, a Mercedes, and he's making $20,000 a year, but he could afford these car payments and his lifestyle. So you go stated. It's just it's the time that we're in. That's why we have the stated loans. The rates are a little higher. I tell everybody, you pay Uncle Sam, you pay me. And then we go full doc. If it's a very competitive deal, the guy's clean, he got the tax returns, we'll go to the bank and we'll get him the best rate possible. But that's why when we look at the file, we analyze the whole file and then figure out which boxes we're going to put in. And we sit down and explain to them why we're doing what we're doing with the type of loan. And we're doing the same thing with the mortgage brokers that we work with, and explain to them how we're structuring the deal and why we're structuring it that way.
That's one of the things I like what I like about you doing business, because you always have the client's best interest first, putting them into a program that's better suited for them. Be it, if they had great credit, you would steer them toward, to bank finance, and if they were a little bit challenged, then you would go to a non-bank lender. But you always had their best interest in mind in terms of where you place them into the marketplace.
I mean, I try to make sense and explain to him exactly why I'm doing it. I mean, I just had a guy leave now. He has a 760 credit score, but he wants a 30-year fix, and the rates are higher. They're going to be somewhere in the high fives, low sixes. And I explained to him, it's a vacant 4-family house. It's clean, but it's still vacant. Banks aren't too happy. They don't want to do stuff like that. They're looking at the deal and they're looking at it differently. So I try to explain to the borrower why we're doing it. And I tell them I charge the same fee whether I'm doing a $100,000 loan, I'm doing $1 million loan, whether it's full doc, whether it's stated, we're still making the same. We're trying to close the deal and make it happen. So we try to make sure we can stick in the right box.
Those are the deals that are getting done now. I mean, what deals are not getting done? I mean, you talked about office being out of favor on the street. Is there any other types of transactions that banks and lenders are looking away from?
Land, we've been getting a lot of trucking with land. We're trying to put them with the SBA. So you have a lot of trucking company that need parking. So a lot of banks don't want to deal with that. So we're sticking with the SBA. The banks still not doing the gas stations, the motels. So a lot of stuff we're doing through the SBA if it makes sense. If it doesn't make sense, they're not showing anything, then we can't. People who don't have experience, they're taking a big hit. You have a lot of people that they're trying to put their money together, and you have 4 or 5 guys putting their money together to buy a property. They've never had any experience. Those are a little tougher, mainly because of the experience of the borrower. The credit, every now and then we'll get someone with the bad credit where we just can't do it because of the credit. But if the deal makes sense, and the problem we're having where a lot of deals die also is where it won't debt cover. And I'll explain to them why it won't debt cover, and they still want to do a 75%. And I say, look, it's going to debt cover at 65% of the purchase price. And that doesn't mean the property's worth, let's say, $1 million. That means that if the property's worth $1 million, I'll give you 75% is $750 loan amount. But if they're buying the property for $1 million, it's only worth $8 million. You're going to get 65% of the $1 million, which is really 75% of what the real value is of $800,000. But they're still overpaying for these properties. So it's either you put up the balance of the money or you have to walk away, or no one's going to be able to do the deal. With the commercial, where a lot of people don't understand, it's all numbers, it's all debt coverage. If it doesn't debt service, you're not getting the loan. You're going to have to back into the loan. So instead of putting 25% down, you're going to put 35, 40, but you're putting 35% or 40 of the inflated price, not the real value of the house. And we had a deal that we closed where the guy bought the building for $1 million and it came in at $800,000. Okay, and the appraisal was there. He came up with the extra $200,000 because he wanted the building. And when I did it in the beginning, I said, look, it's not going to debt cover. This is what it's going to come in at. This is what the value I think is, and this is how much of a loan amount you're going to do. And at the end, that's really what happened. And he came up with the extra $200,000 and he took the building. But I did prepare him prior to us spending the money.
Seems like you do a lot of educating between your bars, and I know you do business to get a lot of referrals from the residential brokers, and it's kind of a different underwriting scenario with when you come from a residential background trying to do commercial loans.
It's different. We're not emotional. We're not looking. A lot of the residential people think because a guy has $1 million, he's loaded, he has this. I don't care what he has. We're looking at every single individual property, and that's what's going to debt cover. If you're making $1 million a year, we don't want your income to support the mortgage. We want the income of the property to support it. And that's what a lot of people have to understand. A lot of the residential people have to get through their heads. This is the way it works. We're not emotional. We don't care who the person is. I mean, as long as the property debt cover, you can make $50,000. You can make $1 million a year. If the property's not debt covering, it's not debt covering.
And as a lender, we're going to size it to what the property can support versus what the borrower can support.
Yes.
So I'm going to just jump off of this and just a couple of other things that are in the marketplace. Cannabis. Do you deal with cannabis financing at all?
Yes, we're starting to play with the cannabis. We closed a few deals in California, Colorado, Texas, New Jersey. We're starting to work around. We got a deal in Michigan. I got a deal in Washington, DC. So in Jersey is new, New York is new. So we're trying to figure it out. What happens is you might have lenders in those states that have been around for a while and they know the market. So in New York and New Jersey, everybody's still wondering what's going on. Today, I got a call from a guy who finally got his first retail license in New Jersey. So we're trying to figure out how to structure that one. And we could do anything from a bridge loan, 2-3 year bridge loan, to a bank loan. And it's not a conventional bank. It might be a credit union, it might be a small bank, or it might be a small fund that they're willing to do the loan. So not everybody's looking at it, and we're looking at the real estate only. We're not looking at the business. In New York and New Jersey, a lot of people are starting to get the license. They don't have the funds, so they might use investors or private investors to go in there with them. But we're still trying to figure it out. I mean, we are doing them, but we're looking at every single deal differently. There's no formula to get this thing done.
All right. Thoughts on cryptocurrency into commercial mortgages?
I don't even know. I mean, I started playing with crypto, and now it's pretty sad. But they're trying to do something later on with crypto. I guess that'll be working out. I have clients. I had a client who was buying a condo. He had like $1 million worth of crypto. It was like a 50% loan to value. I mean, today that $1 million is probably about 750, but we don't know. I mean, I guess that's something for the future. We're still playing with the crypto. You could use money from crypto accounts as a down payment. You just got to make sure you pull everything out before it drops again. But you could use cryptocurrency as a down payment to buy a property.
We're running up against our time allotment here. Just a final thought out there. I mean, words of advice that you can give to either to borrowers who are looking for finance in the marketplace, or mortgage brokers, be it residential, who are trying to maybe transition into commercial originations, or existing commercial brokers. What are the words of advice that you would give to them?
The number one question I ask everybody that looks at me like if I'm crazy is, why do you want to buy this building? Okay, that's the one question I ask everybody. And I tell the brokers, I say, why does he want to buy it? And their answer is, what do we care? I said, we do care. Because, if he's buying a warehouse, why? He's buying an apartment building, why? Is it a great deal? Is he getting a good return? You have to look at the numbers and see if the numbers make sense. You have to learn how to analyze and look at the properties and see if it can support the loan. You also have to find out why your borrower wants to buy that building, especially when you get a small mixed-use property with 1 store, 2 apartments. They're not that great of an investment. But if the guy's going to buy it to move his business there, it's a better deal. A lot of times people don't ask why they're buying it. You're buying a warehouse. Okay, why are you going to buy a warehouse as an investment? It's a lousy investment. Oh, I'm going to move my business. A lot of times people don't ask those questions. Why? Because that helps us structure the deal when we find out why you want to buy this property, what you're going to do with it, what are your thoughts, what are your plans for the future. That helps us in the write-up when we sell the loan to the lender or whoever we're talking to about the loan.
Yeah. And for a residential broker who wants to transition, refinance his business is about 80% off. What would your advice be to a residential broker who wants to transition?
Right now, we're getting a lot of calls from residential brokers, and we're walking them through. I try to teach them and talk to them and walk them through the deals and explain to them why we do what we do, why we're looking for the debt coverage, why we're looking for the vacancy. I mean, a lot of times they say, well, the property's never vacant. Don't matter. We're still taking vacancy. We're taking maintenance, management, reserves. You have to work with the formula. You can't just say, okay, this is collecting 50,000, a tax and insurance of 10, so they're making 40. You have to also add other expenses to make the deal make sense. The banks are going to do it. So you're better off doing it up front, because if you don't do it and you try to sell the deal, the bank's going to knock down the loan to value and it's going to kill the deal. So you have to make sure you get all the numbers from the property.
Perfect. I see Anthony's back on, so he must be up against our time right now. I want to thank everybody. Yes.
No. I wanted to just ask you, how many deals like say for instance, Lending One, when they can't do a deal, how many deals would you like? How many times have you has a deal that you couldn't do saved by Enrique? Was he able to save quite a few of your deals?
Deals that don't fit our box, I always refer out to other lenders or other
Yeah,
intermediaries that can help the borrower in the transaction. I mean, Lending One's not the end all to be all. We see a lot of
sure.
transactions that don't fit our box. So we try to I try to help my clients by pointing them in the right direction. It could be another lender or it could be an intermediary that we point them to. So
Yeah. Now, I was just wondering because it reminds me of me a little bit, Enrique, because used to be a mortgage broker with Proto Equities a long time ago, but I had so many tools of being able to save so many deals. And, that, of course, lenders that could not do. So, Enrique, you do serve a very valuable purpose, man, being a mortgage broker and representing so many different banks. It was an honor for you to also be on the panel in Atlantic City. So it was nice to have you down there.
Thank you
But
for inviting me.
guys, yeah, by all means, in the future, they're on. We're still going to invite you all the time. You add great value to the panels. Guys, Michael, oh man, thanks. I know we have Lending One on 2 other times. It was awesome to hear from your whole staff. You're a great host and you guys are great friends and I really appreciate it. And do you want to say anything else, Mike, before we go?
no, Anthony, I thank you for putting this on. It's been a
By all
big
means.
endeavor. The whole week you've been active on this conference. We do appreciate you, and I want to thank everybody who stayed with us for 30 minutes for this candid conversation I had with Enrique. And again, Anthony, thank you for putting this on.
No, you're so welcome, and thank you guys for being sponsors.
Yeah.
Most important. Guys, you be well. Again, everybody will get a thank you letter from Enrique's team. They'll have your whole entire list of the streaming and the people that did come on live today to view. I'm sorry that there was no Q&A, but you can ask Enrique many questions thereafter once you get his thank you letter and his contact information, as well as we'll put Michael's contact information on there as well. This concludes our webinar. So take care, everybody, and looking forward to see you guys later. Okay, thanks, guys. I appreciate it.
Thank you, Mike.
Thank you,
Bye,
guys.
guys.